Okay, today we're going to be learning about the moving average. It is a simple equation and a useful technical indicator that is used to smooth out varying price fluctuations so we can better see a trend or direction of a. Okay, so for the math type, here is the equation for the moving average. As you can see, is a very simple equation. MA equals moving average. C1 will be the closing price, the first closing price that we look at. C2 is the second closing price. C3 is the third closing price, and so forth until we get to the final closing price that we're looking at. And then N will be the number of closing prices that we're looking at in total. So for example, if we're doing a 5-day moving average, so one trading week, C1 would be the first closing price we're looking at, C2 the second, C3 the third, C4 for the fourth one, and then the fifth one would be CN because that's the total amount of closing prices that we're looking at, and N will also be 5 because we're looking at 5 different price periods. Now let's see this equation in action. Okay, so this line here is the 5-day moving average. That's an example that we're looking at as a 5-day moving average, spanning over somewhere around the 14th of October to about the 7th of December. But for this example, we are going to be calculating the 5-day moving average for November the 27th. So we're going to look to calculate this point right here on the line. So how we do that is we take the closing price of November the 27th, which is $3,638.40. And then we look at 4 closing prices before November the 27th, because that's going to give us 5 price periods that we're looking at, the 5-day moving average. So then we're going to get November 25th, which is $3,629.70. And you're probably wondering why it skipped November the 26th. That's because that was Thanksgiving, so it wasn't a trading day. And then we're going to look at November the 24th, which is $3,635.40. And then so forth, November the 23rd and November the 20th here. So all these values are on this line right here. These are the 5 closing prices, and they equal $18,038.70 altogether. And then we're going to divide that by 5. And that, once again, we're dividing by 5 because we're using 5 price periods. And the final value, the final product, is $3,607.74, and that is the moving average for November the 27th. So if you look here, that's going to line up with $3,607.74, and that's what all these points on the line are. These are all a 5-day moving average for their closing period. So this one right here will be the 5-day moving average for, I think that is November the 23rd. To further this example, let's see what the point here would be, and this is the moving average for November the 30th. Okay, so it's going to be the same equation, just different values. We're going to take November 30th is now the first closing price, so that's $3,621.60. That goes right there. Now, November 27th, which was the first closing price on the first for the previous equation, is now going to be the second closing price, which is $3,638.40. And then November 25th will be the third closing price. November 24th will be the fourth closing price, and November 23rd will be the fifth closing price. Notice how we're not using November 20th in this equation. Even though we used in the previous one, we're not using this equation because we're finding the 5-day moving average of November the 30th, and November the 20th is the 6th day from November the 30th. So we're not looking at a 6-day moving average, we're looking only at a 5-day here. So we're not going to include that particular piece of data. So these 5 closing averages all summed up is going to be $18,102.70. We divide by 5 because once again we're using 5 separate price periods. We get a moving average for November the 30th of $3,620.54. And if we look here, it lines up with that. Okay, I wanted to show you that you do not need to calculate the moving average for every closing price to draw your moving average line. Also, the moving average doesn't need to be limited to 5 days. It can be as long as you want. Most charting applications, this one's on TradingView right here, but most of them are fairly similar, will have an indicators button. TradingView has it right up here. And if you type in moving average, it will automatically set up the line for you. Now the default for TradingView is 9 trading days, but you can change that to what you want. So if you click over here and adjust the length is how many trading days you want the moving average to be. So you can change that to, let's say, 20. And there you have your 20-day moving average. So now that we know how to calculate the moving average, what is a practical strategy when only using the moving average to predict the stock market? Now, the first thing I want to advise is I wouldn't recommend only using the moving average. It should be used in conjunction with many other technical indicators. But if you're to only use the moving average, a strategy I find successful is to buy long when the close of the S&P 500 crosses above its 126-day moving average, and to sell when the close of the S&P 500 falls below its 126-day moving average.